7, so I guess we can go ahead and get started. I'm John Lee with the St. Louis Real Estate Investors Association, and tonight we have a very special guest, Kinzer with Equity Trust Company, and he's going to kind of give us a sneak preview of what we're in store for next week on the 21st, which will be 6 p.m. to 10. It's a 4-hour wealth building workshop, which is extremely educational. We're so happy that we were able to secure these guys, because this is very special for us. So thank you so much for being here, Kent, and please fill us in with what we're in store for.
Excellent. John, thank you so much. Now, before I get started, I want to make sure, let's see. Oh, I need the screen share.
Okay.
If you could enable my screen share.
Yes, please. I will. Let's see.
Okay. Give you just a second, and then we'll get my slide deck up.
Okay. Try that.
Okay. Now, does everyone see my my slides?
There it is.
Okay, perfect. Let me just make sure we're from the beginning. I always want to make sure that people actually see them. I did a talk last week, and it was probably 15 minutes before the organizer broke in and said, hey, we don't see your slides. We only see you. So always best if I check to make sure they're in front of us. So, John, thank you so much, and thanks for giving me the invitation, and also working with us on the workshop that we're going to be back doing next Tuesday. Before I get started, I just want to say a couple of words about the importance of not just joining St. Louis REIA, but being an active participant. I get the chance to travel all over the country for Equity Trust and talk to REIAs all around the country, interacting and meeting very, very successful real estate investors. And I can tell you the one common denominator I see is that the people who are the most successful belong to and are an active participant of their REIA. That's where you're going to find out what's really going on in the local market, where you're going to have a chance to rub elbows with some very successful local investors. And both tonight and on next Tuesday, we're going to be talking about a couple of investors that are part of the St. Louis REIA. Some of our shining stars at Equity Trust are actually members of the St. Louis REIA. And yeah, that's why I encourage you to get to those meetings when we can get back into our regular meetings. I know this is our new normal for a while, but you'll have a chance to meet with and talk to some very, very knowledgeable investors. People are really making a difference in their lives, their families' lives. These are part of the membership of St. Louis REIA. So just want to mention that real quick. I encourage people not just join, but be an active participant. When Lloyd and John and Ruth, when they're looking for volunteers to do something, those that raise their hand and get involved, those are the ones that actually get the most out of the local REIA. So let me just tell you a little bit about what we're going to be covering tonight. This first slide just tells you a little bit about the background of our company, and I'll get into some more detail with Equity Trust and what we are, who we are in the space as we go on. But we are widely recognized as the #1 custodian for self-directed IRAs. We specialize in real estate. As you can see, we do 1.2 million transactions annually. That's about 3,500 transactions a week. A day. Nobody in the space does more transactions in real estate than Equity Trust. So what we're going to cover this evening is I want to tell people what self-directed IRAs are. Make sure we have some base knowledge. Tonight will be like a high-level overview. Next Monday, we're going to get into a deeper dive, and I'll be talking about what the agenda will cover on next Monday's workshop. I want to introduce the 7 different types of accounts that someone can hold with Equity Trust and do a self-directed IRA. I really want to talk about the taxation of the accounts, and I'll be showing you how to move your money from your taxable account to your tax-free account, so that you can do your real estate investing free of taxes. We'll be going through some case studies. All of the case studies I'm reviewing this evening, these are members of REIAs. And it's not unusual that every single case study that I come across, they're a member of a REIA. So every case study that we're going to be talking about tonight, these are people that are members of a REIA. And what the next steps are. Now, the next steps are not for you to run out and open an account. That's not what I'm trying to do here this evening. The next step is to register for a free workshop that we're going to be doing a week from today, Tuesday, July 21st. It'll be starting at 6 p.m. Central Time. The very best educator in our space, John Bowens, will be leading the workshop. If anyone has ever attended a John Bowens workshop, you know that he gives more education, and the quality of his education is second to none. Talks a lot about a lot of different real estate transactions that he himself is actively doing. John will be the person leading the workshop on the 21st. Now, if you've ever attended an equity trust workshop, or anyone in our space, this is a very important slide. It's also a required slide. You have to understand who we are in this industry. Equity trust is a passive custodian. And what that means is equity trust will not render any tax, legal, or financial advice. We can't do that. We are not fiduciaries to your account, so we can't tell you that you should invest in 1, 2, 3, 4 Main Street because it makes sense for you. We can tell you how to do it out of your IRA, but we can't tell you what to invest in. That due diligence is up to each investor. And it's very, very important that you understand that whenever you do a real estate investment, you know who you're investing with, what you're investing in, that you surround yourself with knowledgeable people. And you can really find a lot of those knowledgeable people right at that local REIA. Real estate attorneys, tax advisors, CPAs. Those are the kind of people that you want to surround yourself with, so that you have a good team of people to call on. So tonight's going to be about education. Again, I'm not giving you any tax, legal, or financial advice. This is education. So let's get to the good stuff. Let me tell you a little bit about my background and a little bit about Equity Trust. I grew up in Nebraska. I'm actually a Nebraska boy, raised on a farm in Nebraska. I still consider Nebraska home, even though now I live in Ohio and have for quite a while. After college, I moved to Texas. I started a sportswear company. I spent about 17, 18 years in local sportswear, specializing in college sportswear. Grew that business to 485 campuses in 36 states. Sold that, went into real estate investing. So I've been doing real estate investing actually for quite a while. My first investment was in the mid 80s. And started with mobile home investing, then went to single family, then commercial real estate. So along the way, I actually stumbled upon Equity Trust by accident. I thought I knew a lot about investing. I've been doing it for a long time, yet I had never heard of a self-directed IRA. Like many investors, many people who come to our workshops, the first thing I thought was, is this something you can actually do? Because it sounded too good to be true to be able to do my real estate investing free of taxes. So I had to do some research myself. And then once I hired on, I realized, yes, not just it can be done, but the process to go through. I shudder to think where I would be today had I known about this stuff 10, 20, 30 years ago. But you got a leg up. You're here today, so we'll be giving you some education on what's possible for you. So Equity Trust, we've been around for over 45 years, industry leader in the self-directed IRA space. Little story about how Equity Trust even got its start. It's tied back into a REIA meeting. Throughout the night, I'm going to be going back to the power of the REIA. Our founder, Dick Desich, he is widely considered to be the grandfather of the self-directed IRA industry. He was actually attending a local REIA meeting looking for investors for a real estate deal he was working on. Just so happened that the speaker that night at an Akron, Ohio REIA meeting was talking about saving for retirement. And the light bulb went off in his head, thinking, could I use those real estate, those IRA funds to invest in my real estate deal? So following the meeting, he went back, did the research, hired his attorneys, his accountants to go back into tax code to see if there's anything prohibiting that. And there was not. So Mr. Desich was actually one of the very first people ever to do what is now called a self-directed IRA. And from that first customer, we've grown to 170,000 clients today. We custody over $28 billion in assets under administration. We'll talk a little bit more as we get into it, but about our brokerage service fees, broker service division, and also about Equity Trust being a custodian. Just a little high level, a little bit about Equity Trust. So write this down, compounded interest in the absence of taxation. This is really the theme of what I'm going to be talking about tonight, and we're going to be talking a very deep dive into this on the 21st. Taking it a step further, what about real estate investing in the absence of taxation? Real estate investing in the absence of taxation. That's a very, very powerful statement, very powerful tool. That's really what Equity Trust is known for, helping people invest and save as much as possible on taxes. This is a good example of what I'm talking about when I say investing or compounded interest in the absence of taxation. These are two identical investments. The investment started with $20,000, invested for 20 years at a rate of return of 12%. On your left, you're investing in non-IRA money. After 20 years, you'd have $112,000. On the right, if you were investing inside of an IRA, you'd have $192,000. The difference of that $80,000 is the just crippling effect of taxes. You're giving 20-25% every year to your favorite uncle. We're going to talk to you a lot about how you can invest in a tax advantaged environment, and when you're doing it in a Roth IRA in a tax-free environment. Got a couple of assignments for you tonight. The first one is to go out and pick up the book, The Power of Zero. The Power of Zero by David McKnight. Good read. It's a very quick read. It's about 125, 130 pages. Ideas on how to move your money from your taxable buckets to your non-taxable buckets. Setting yourself up for a 0% effective tax rate before you retire. My spouse and I, we read this together, and we started doing some of these strategies about 5 years ago, knowing that by the time we retire, we would have had all of our money moved into our non-taxable buckets. So we do almost all of our investing now out of our tax-free buckets, and everything is growing in a tax-free environment. We'll talk to you a lot about how to move those monies from one bucket to another, basically how to avoid taxes in your investing going forward. And that's that's a theme of what we're going to be talking about on the 21st as well. So I want to get started. Number one is just the definition of what a self-directed IRA is. Normally at a meeting, I'll ask for the audience, what is it? I get a lot of answers about, it's an IRA that allows you to invest in real estate. Very true that that is something you can do with a self-directed IRA, but the actual answer is that there actually is no such thing as a self-directed IRA. That is just an industry term. That is not the type of an account. The accounts that you hold with Equity Trust or custodians like us in the self-directed IRA space, those accounts are identical to the same accounts that you hold with Fidelity, Schwab, T. Rowe Price. The difference is not in the account itself. It's actually in the custodian that holds that account. So Equity Trust is a custodian that specializes in holding alternative assets. And that is anything outside of just stocks, bonds, and mutual funds. We have clients that primarily invest in real estate-backed notes, but it's really whatever you have knowledge of, whatever you have expertise in, you can be investing in your self-directed IRA. The IRS tells us what you cannot invest in, not what you can invest in. And it's actually a very, very short list of things that you cannot invest in. That's art, antiques, collectibles, alcoholic beverages, insurance policies, S corporations. Beyond that small list, the world is really open to you. So as I said, most of our clients invest in real estate or real estate-backed notes. But I had a client in Kentucky. They bred thoroughbred racehorses. They actually ran a horse that was partially owned by an IRA in the Kentucky Derby. The horse didn't win, but today their IRA is collecting the stud fees from that horse. Mm-hmm. That's what they understood. So that's what they were investing in their self-directed IRA. Now, we understand real estate. So most of the talk is going to focus on real estate-backed assets. But understand that your IRA does not only have to invest in stocks, bonds, and mutual funds. You can be investing in alternatives like real estate. So as I said, there are 7 different types of accounts. I want to just briefly go over them just to give you some base knowledge of the types of accounts. These are just the vehicles. Once you've got the account set up, it's what you can invest with them that really gets to be exciting. But I want to introduce the accounts. We will go into much more detail at the workshop on the 21st, and make sure you understand the taxation of each account and how you can move monies between your taxable accounts and into your non-taxable accounts. So these accounts fall into 3 different buckets. They are individual accounts, business accounts, and then there's some specialty accounts. The individual accounts, these are accounts that any of us can have. Any of us could have an individual IRA, or we can have a Roth IRA. I'll get into the limitations and what the differences are between the accounts. But anyone who has earned income can open a traditional or a Roth IRA. A traditional is a tax-deferred vehicle, meaning that as you put the money into the account, you're going to take that off of your ordinary income tax. You're going to get a tax deduction every year. As the account grows and grows and grows, when you take the money out in your retirement years, that's when you're going to be taxed on that growth or on that account. A Roth IRA is referred to as a tax-free account. No such thing as a tax-free account. It just means that you paid the taxes on the front end. Whatever you have invested with, as it grows and grows and grows, when you take that money out in retirement, it's completely free of ordinary income tax and capital gains. Very powerful account. I'm going to spend a lot of time both tonight and at the workshop on the 21st. John will spend a lot of time talking about the various Roth IRA accounts. Now the business accounts, a lot of us are very familiar with the 401ks, type of a business account. But if you are self-employed, we want to make sure that we know that, and John will take some polls on the 21st so that you understand what you have available to you. Self-employed people can have the SEP or solo K. The advantage of these accounts is you can get a lot more money into the accounts to grow your account. For example, if you're under the age of 50, a SEP or a solo, you can get up to $57,000 a year into these accounts. Over the age of 50, it goes to $63,500. You do have to meet certain income requirements, but that's just the maximum amount that you can get into these accounts. Certainly a lot more than what you could if you were just had a 401k, the $19,500 or $26,000, depending upon your age. But these are the different self-employed accounts or business accounts. And again, I'll get into the taxation as I get into the presentation. The solo K, John will cover the solo K on the workshop. Very versatile account, and the solo K again is a higher limits. It has both a tax deferred as well as a tax-free Roth account. So we will get into the self-employed accounts at our workshop as well. And the last 2 to introduce, the specialty accounts, are the Coverdale Education Savings Account and then the Health Savings Account. The Coverdale Education Savings Account, or the CESA, used for educational expenses. And I've got a slide on just the CESA to give you a little more detail. Health Savings Account, very powerful account. It is the only account that lives in both the tax-deferred and the tax-free environment. And I'll get into what I mean by that. So the question I'm going to ask tonight, and we're going to be talking about at the workshop, when do you want to pay your taxes? Do you want to pay your taxes on the seed, or do you want to pay the taxes on the crop? Seed or the crop? Pretty simple. Most people would say you want to pay on the seed when it's as small as possible. But believe it or not, most Americans actually pay taxes on the crop. We choose to get the tax deduction now, not thinking about what's going to happen 20, 30, 40 years down the road. We end up costing ourselves more in taxes by choosing to get the deduction now versus having our investments grow in a tax-free environment. So I'm hoping to introduce a little bit of a change of thought pattern tonight. And John will spend an awful lot of time. He's a very, very passionate person when it comes to tax-free investing. And his case studies, his examples, I think will really push people to say, why am I doing this in a traditional environment when I really should be thinking differently about my taxes and moving your monies from the tax deferred buckets to the tax-free buckets. So let's talk about the accounts that most Americans have, the traditional IRAs. The traditional IRAs are the 401ks, your work plans, your 401ks, the 403bs, your thrift savings plan. Some of us still have a pension, and those SEP and simple accounts. Plus, you might have, you can have your own individual traditional IRA. All of these are examples of traditional IRAs or tax deferred accounts, meaning that when you put the money in, you're going to get the deduction, but when you take the money out in your retirement years, you're going to have to pay the tax bill at that time. And we can also, beyond just our employer plan, we can also have our own individual plan, our individual IRA. If you're under the age of 50, we can put $6,000 a year into an IRA. Over the age of 50, it's $7,000 for your individual account. I like the rule of spousal contribution. If I work, but my spouse does not, you can actually be making open an account in your spouse's name and make a contribution to both your account and your spouse's account. So you can double your individual contribution limits. RMD, that stands for Required Minimum Distribution, is now 72. Used to be 70 and a half. That just changed this year with the CARES and Security Act. It was 70 and a half. It's now moved to 72. And what that means is keep in mind that with a traditional IRA, you haven't paid taxes on this money yet. You haven't paid taxes on any of the growth. You got your tax deduction when you put the money in, and it's been growing and you haven't paid taxes yet. So at age 72 is required minimum distribution. In other words, you have to start withdrawing these from these accounts at age 72. When you take your money out, it's added to your ordinary income tax, and you're taxed on whatever your rate is that year. So you are eventually taxed on this money when you start to withdraw or draw down these accounts in your retirement years. So just a quick illustration on the traditional accounts I just talked about. You put your money in, you're doing your investing. If you're doing it in self-directed IRA, you might be investing in real estate-backed notes. If you're in traditional markets, it's stock bonds and mutual funds. When you take the money out, and it's 59 and a half, very, very important age. That is the age you can start withdrawing your accounts and you're not going to be penalized. It's not 62, it's not 65. That's Social Security and Medicare. It's 59 and a half. That is an age that I'm not that far off from, and I'm looking forward to hitting that number. So at age 59 and a half, that is when you can start taking money out of your qualified retirement plans. When you take the money out of a traditional account in your retirement years, that's when you're going to pay the taxes on it. So let's talk about the distributions. Again, 59 and a half. If I have a traditional IRA and I take money out of my account prior to 59 and a half, you are going to be hit with a penalty. It's actually a 10% penalty of whatever you take out, and you still have to pay the taxes on top of that. So you really, again, these are retirement accounts. You really do not want to take the money out of your retirement accounts until you hit that magic 59 and a half. So distribution post 59 and a half, as I said, then it gets added to your income tax, and you're going to pay the tax based on whatever your tax rate is that year. So just a quick example, if I grew my account to $1 million during my working years, the first year I retire, I want to take out $100,000, and I'm in a 20% effective tax rate. That means I'm going to have a $20,000 tax bill. I'm not taking out $100,000. I really end up with $80,000. And again, the required minimum distribution is going to kick in at age 72. What I believe is a much better way of investing, and that is a Roth IRA. Passionate about Roth IRAs. Once I hired on to Equity Trust, I already had my Roth IRA. I become uber a cheerleader for the Roth IRA, now that I understand that I can do my real estate investing inside of a Roth IRA, whatever I grow my accounts to is going to be completely free of taxes in the future. So this is William Roth. The account is named in his honor. Very tenacious senator, late senator from Delaware. He introduced the legislation, the Roth legislation, 7 times before it was actually adopted. But it's because of him that Americans can invest in a tax-free environment and really grow and preserve their wealth. So a little bit about how to fund a Roth. You can transfer, if you have an existing Roth, you can bring that over to Equity Trust, and then you can start doing your real estate investing out of that account. We'll talk about that. Just like with the traditional accounts, anyone can open their own individual Roth IRA. If you're under the age of 50, same limitations. Under the age of 50, $6,000. Over the age of 50, $7,000. Same way with the traditional. If I work, but my spouse does not, I can open an account in my spouse's name and make contributions to both accounts. So long as I have earned income, then I'm able to contribute to both accounts. Love this about the Roth IRA. No RMDs. I am not required to take this money out. Now, there have been some recent changes to the Roth IRA. If I die, my account passes to my spouse. It's completely free of taxes, avoids probate. My spouse can continue to make the investments in the account, continue to grow that account. When it passes to my spouse, there is no required minimum distributions for my spouse. If she wants to leave it to our kids, when it passes to another generation, now there is a new rule with a Roth that you now have 10 years to distribute that account when it passes to another generation or someone that you're not married to. The one exception to that is if you leave your account to a minor child, someone who's under the age of 18, then that 10-year distribution rule does not start until they reach the age of 18. Then they would have 10 years to distribute that. When that account is distributed, it's free of taxes. It's a Roth IRA. There's no taxes paid on this. Doesn't matter how large the account grows to. There is no taxes paid out of a Roth IRA. So let's just a quick illustration on the Roth. So I put the money in. I've already paid the taxes on the Roth. I'm not getting a tax deduction. So if it's an individual account, I'm writing a check out of my personal checking account to open that account or fund that account every year. If I have a Roth 401k, I'm not getting a deduction for the money I put into those accounts. But the beauty of it is whatever I invest in, if I have a Roth IRA, and I'm investing in real estate backed notes, or even stocks, bonds, and mutual funds, whatever those accounts are growing to at age 59 and a half, when I take my money out, it is completely free of taxes. No capital gains, no ordinary income tax. Again, think of doing your real estate investing inside of a Roth IRA. Whatever growth rate you're enjoying every year, that can be in a tax-free environment. You're not going to pay any taxes on this money in your retirement years. A couple things on the Roth IRA, staying on the Roth. Some people will say, well, I like what you're saying, but I make too much money. I'm a high net worth individual. I can't have a Roth. There is a modified adjusted gross income table where, yes, if you made these numbers, you can't contribute to a Roth. But I love it when Congress makes a rule. There's usually an alternative to that rule or a way around that rule. And with a Roth IRA, it's nothing more than a conversion. The slang term is a backdoor IRA. That's really just a slang term. A backdoor IRA is nothing more than contributing to a traditional IRA. Is remember, anyone can have a traditional. There's no income limits on a traditional. Once you contribute to an IRA, you can convert to a Roth. If you're a high net worth individual, get with your accountant Your account would file a Form 8806, letting them know that it's a non-deductible IRA contribution, Form 8806. That's for the personal IRA. We'll get into converting from your traditional to your tax-free buckets, and we'll spend a lot of time with this at the workshop on the 21st. Couple more rules, and I had some questions about this prior to tonight's meeting about the 5-year seasoning rule of a Roth IRA. So a Roth IRA has to season for 5 years before you can take the growth of the account out. So the question was asked, if I have an account and I've had it for 5 years at another brokerage firm, if I brought the account over to Equity Trust, does that account have to season for another 5 years? No, it does not. Roths have a 5-year seasoning rule. It doesn't matter where your account was opened. If you opened it at Fidelity, you made one contribution 5 years ago, and then you brought it over to Equity Trust, that account is already seasoned. So there is a seasoning rule with a Roth IRA. The other thing to know about Roth IRAs is if you're going to convert funds, if you're going to convert from a traditional to a Roth, then that 5-year seasoning rule kicks in at the time you do that conversion, just on those monies. So we'll use several examples of this at the workshop. But I want to make sure and I introduce the seasoning rule so that people have that base knowledge. So when they get to the workshop, we're not starting from scratch. Couple of Roth conversions, very, very powerful. What I love about the IRS is you can convert from your taxable buckets to your non-taxable bucket. You're choosing to pay the taxes today. Once it's converted into a Roth, whatever you grow that account to, whatever you're invested in now grows completely free of taxes. So let me illustrate that with this example. I have a $100,000 401k, a traditional IRA. If I am currently in a 20% effective tax bracket, if I wanted to convert that $100,000 from a traditional to a Roth, I would have a $20,000 tax bill this year. I see a lot of clients that will choose to do their conversion at the start of a year, knowing that the tax bill isn't due until the April 15th tax day the following year. Yes, I know this year was July 15th, but normally April 15th. Again, whenever you convert, your taxes are going to be due the next tax year. So if I converted this year, my tax bill is going to be due April 15th of 2021. In this illustration, I have the tax bill coming outside of the IRA. You could, if you wanted to, pay the taxes inside of your IRA. In other words, if you were going to convert the whole 100,000, you would 20,000 would have to come out of that IRA. So you would end up with $80,000 rather than 100,000. That's just taking your tax bill out and paying it inside the IRA. Understand that on conversions, and we'll spend a considerable amount of time on conversions at the workshop. The IRS does not have a rule on how many times you can convert in a year or in what denominations. When my spouse and I first started doing this, we did $10,000 the first year just to see what our tax consequence would be. So you can convert in smaller increments. Rather than 100,000, this example is converting just 50,000. But again, I started with just 10,000 just to see what the tax consequence would be. Now I've stepped it up from there. And in my last few years of working years, I will complete the conversion of my 401k to a Roth so that I'm in a tax-free environment in my retirement years. So just a bit on tax IRA converting. Two more accounts to talk about, and then I want to get to some case studies. As I said, the health savings account. This is really an overlooked account. People are really not investing enough with health savings accounts. it's the only account that is out there where you get a deduction when you make a contribution to the account, and it lives in that Roth environment. In other words, it grows tax-free. So you can actually be doing your real estate investing inside of a health savings account, and you're saving for future medical expenses. When you put your money in, and if you're single, you can get up to $35.50 in. If you're under the age of 55, over 55 is $45.50, and these are the family plans. Though you have to have a high deductible health plan. High deductible health plan is if you have a deductible of $1,400 or more. If you're single, $2,800 or more if it's a family plan. But you can transfer your high deductible health plan, your health savings account, from where it is now with an insurance company. You can actually transfer that to Equity Trust, and it still stays within a health savings account, and be doing your real estate investing with your HSA. What I like about an HSA is not to use it or lose it. This account is growing and growing and growing to be used for qualified medical expenses when needed. So that's prescriptions. It could be doctor's bills, hospital bills, nursing home. Any qualified medical expense can be reimbursed out of a health savings account. And understand, this is one of the accounts that you can be doing your real estate investing from. And the last account I want to talk about before I talk about some case studies is the Coverdale Education Savings Account. And just like the account says, it's for saving for education. Anybody can open up an account for a minor child. I could open an account for my neighbor if I wanted to, or my nieces and nephews. It has to be managed by the parent or guardian. The contribution limits is $2,000 a year. It can be used for any qualified educational expense, K through post-secondary. So whether that be books, tuition, uniforms, housing, any qualified educational expense can be paid for out of a Coverdale Education Savings Account. This is another one of those accounts that grows tax-free, and it's free of taxes when it's used to cover educational expenses. The account stays in that child's name until they reach the age of 30. At the age of 30, the account can be transferred to another family member. It doesn't have a tax consequence. It can be then used for another child in that family. If the account was open for someone with special needs, then there is no limitation in terms of that account having to be, doesn't have an age limit at that point in time. So if it's special needs child, they can keep that account and can keep growing that account and using it for educational expenses. So that was a very quick example of the 7 different types of accounts. We're going to slow down on our workshop and go through case studies on each and every account. Tonight, I'm just going to go through a few different case studies, staying focused on real estate and talking about a couple of things that are possible with these various accounts. 10 different ways to partner your IRA. I'm going to go through a couple of them tonight with case studies. At our workshop, we're going to go through all 10. So when John teaches a workshop, he will introduce a case study, someone who is using an account to partner with them and their spouse, or might be them and their business, them and a leveraged IRA. So tonight I'm going to go through a couple different examples of families that are investing together, with someone who's investing with their money and their business money, and then just someone who's doing a straight Roth IRA. But we have created a report out of 10 ways of partnering with a case study on each one of these methods of partnering. When you register for the workshop, you actually get this report for free. It's something that we send back in a download to you. But again, I want to go through a couple of different examples tonight, and then I'll talk to you a little bit more about the workshop that's going to be coming up. As I said, you might actually recognize some of these people. Another reason why it pays to be an active member of the St. Louis REIA, you get to meet some very knowledgeable and experienced real estate investors. This is Jan, Gary, and daughter Brittany. They've been clients of ours, I think it goes back since 2012, I believe. We met them in the field when we were doing a workshop in St. Louis. It's very similar to the workshop that we're going to be doing online. But Jan is a real estate broker. Gary, an engineer. Brittany just started law school. She's had an account with us since she was 13. You might say, well, how can someone have an account when they're 13 years old? She's in a Roth IRA. There is no age limit, as long as you have earned income. Brittany was a very enterprising young lady growing up. She had a dog walking business as well as others, and I know that she worked in her mom's real estate office as well. So long as you have earned income, you can have a Roth IRA. Jan Gary instilled that in Brittany, and she's been doing real estate investing for many, many years. So the motto here, it's the family model, families investing together. A lot of times I'll have people raise their hand and say, well, I thought you couldn't do that. That's prohibited. And there are prohibited transactions. One of them is you're not to invest up and down the lineal line. That's yourself, your parents, your grandparents, your spouse, your kids, your grandkids. The exception is anybody can invest with anyone, so long as you structure the deal properly. So long as everyone is invested in proportion and all of the returns and expenses are paid correctly and proportionally. So I'll take you through this example of how this local family in St. Louis is investing. It's a great family model and really explains how to do it very, very well. So this particular investment, 3 different IRAs, Roth IRAs, were brought together. Start early, retire early, and it's never too late to get started is the motto here. This was actually the 3rd investment that was done with their accounts together. The first couple of investments they did, they leveraged it with a loan. And when you are doing an IRA investment, the only kind of loan that you can have is called a non-recourse loan. Non-recourse loan. And that is a loan where you aren't guaranteeing the loan. Your IRA is not guaranteeing the loan. The only thing that is guaranteeing a loan is the property itself. So this, as I said, this is the 3rd investment that they had done. It was one that they had done without having leverage. They brought all 3 accounts together to do this particular deal. So the 3 accounts, they partnered Jan's IRA, 42%, Gary's 55%, and Brittany, because she was younger at the time, she had 3% of this deal. The deal was purchased for $306,000, and again, Jan's IRA, Gary's IRA, and Brittany's IRA in these percentages. What's very, very important, as I said, is when you're investing, that everyone has to link hands and jump into the deal at the same time. Everyone has to pay everything proportionally, and the profits have to go back into the account in proportion to what each person had. In other words, this being a family model, Jan and Gary could not have come together and done this investment and put 100% of the profit into Brittany's account. That would be prohibited. Everything has to flow in and out of the accounts the same way. So even something as small as the earnest money had to go out of each account proportionally. When they did the rehab, the same way. Each account had to pay for the rehab in proportion to what each investor had. In this example, 5 checks went out from the account at various stages. At the workshop that we're doing on the 21st, Jan and Brittany are actually going to be presenting. There was an interview that we had done with them about one of their recent examples. Jan's going to go into some detail about how she stages her property, how she gets maximum returns. So it's really good local information, and you're going to hear from a local expert in that market. And you might say there's a lot of paperwork in and out. There's an awful lot to do here. We are known for our technology. Literally, you can purchase and manage real estate on your smartphone. At the workshop, we're going to be going through our technology platform. And I know Jan is going to talk a little bit about the technology and using our platform. But again, just to introduce you, when you go on to the Equity Trust portal, It's no different than going onto your bank portal and saying, where do you want the money sent? That's all part of our service. We will be taking you through that portal very slowly so that you understand the technology and how to do your transactions quickly and effectively. Just a couple of before and after pictures. You can see this project as it progresses. Jan in particular, she stages her properties for maximum return. Just does some beautiful, beautiful transactions. Like I said, her and her daughter Brittany will be taking you through one of their recent deals that they had done, and she'll be talking to you about how to stage or why she stages, why she develops the lower level for maximum return. This is an example of this property and how they staged it. She always develops that lower level. It's like doubling the size of the house without changing the footprint and getting maximum returns. So when this particular deal sold, $767,000. And again, the money had to flow back in each account in accordance with what percentage they had invested. So Brittany got 3%, Jan 42, Gary 55. In other words, almost $164,000 in profits flowed back into these three accounts. And because they did it in a Roth IRA, this is completely free of taxes. This $164,000 is now back into their accounts so they can wash, rinse, repeat, and go on to the next deal. And that's exactly what they've done year over year over year. So they'll be talking about some of the recent deals that they've done at our workshop on the 21st. Really encourage you to attend just to hear from Jan and Brittany. I enjoy hearing from Brittany. I learn things from her all the time. I first met her when she was 14 years old, when she was on our stage in Orlando, presenting, a 14-year-old presenting at a conference of 500 people. She was an adult back then with a lot of knowledge and experience. So I encourage you to come to this workshop just to hear from someone of her caliber. So that was a family investing in 3 different accounts. John will be going over case studies of families that have joined multiple accounts together. Not just a Roth IRA, but a CISA, an HSA, traditional IRAs. So he'll be showing you how to partner various accounts together, both with family members, non-family members, and actually taking you through case studies of each type of account, each type of investment structure. So again, a lot of different case studies will be revealed on the 21st. 10 different ways of partnering. John will be going through all 10. The next one I want to talk about, this is a case study, Gary, Maple Heights, Ohio. He's partnering his Roth IRA with his business. Again, something that you can do, just like with the family plan, the family model, you had to pay everything proportionally. Same way when you're doing it, partnering you and your business together. It has to be done proportionally. It has to be titled correctly as well. So this particular deal, the Roth IRA had 75% of the deal. Gary's business had 25% of the deal. As I said, the titling is very, very important. When you title IRA-owned property, it has to be done a very specific way because understand that you don't own the property, your IRA owns the property. So the titling is Equity Trust, Custodian, FBO, stands for benefit of, and this particular one is Gary's IRA. And then it's undivided interest, 75%. And the rest of the titling is his name of his company, LLC, undivided interest, 25%. So that is the titling that has to appear. That's how that piece of property is going to be titled. I will say one thing about, and I think John will probably talk about it as well. I like keeping my name out of public record. I don't title things in my IRA name. I title it in my IRA account number. So that way my name is out of public record. So just a nuance that I like to do. I think John will be talking about that as well. So let's continue on with this deal. There were some repair costs in this particular property. So just like the previous example, because his IRA had 75% of the deal, 75% of the repairs came out of the IRA and 25% out of the business. The total investment in this, $71.5. When he sold it for 116, after closing cost, the money went back into the accounts. So the 75% or 25,875 went back into Gary's Roth IRA. And because it's in a Roth, it's going to be tax-free. 25% was cash. So that cash was returned to Gary's business. And that will get added to his business income, and Gary will end up paying taxes on that 8625. So there are ways of partnering with yourself, with your spouse, with your business. There are multiple ways of partnering together. John will be going through 10 different case studies, 10 different examples of how to partner your IRA together. The next case study is one that we see pretty often. This is just going to be a Roth IRA, buying a piece of real estate. Gary had multiple exit strategies that he was considering on this one. When we got to the ARV, the after repair value, it was high enough that he decided to make this into a buy and hold. Went into this deal thinking it was going to be a fix and sell, but because of the ARV, he ended up hanging on to it. But let's go through this one real quick. So the purchase price for this one was $68,000. This is a duplex in, I think it's Middlefield, Ohio. Purchase price was $68,000. There were about $20,000 in repairs. So there were some replacement windows, an AC, the furnace, etc. About $20,000 in repairs. Now keep in mind, because it was purchased out of his IRA, that $20,000 in repair came from the IRA. You can't write a check out of your bank account to pay for these. That would be prohibited. And we'll go through the prohibited transactions so you understand how to do something and how to do it correctly. So $20,000 in repairs paid for out of the IRA. This is a duplex, 2 units. It has $900 in rent coming back from each unit. $1,800 gross. The reason why Gary kept it, he's into this for $88,000. The ARV value between $135 and $145. Easily could be sold off if you needed to, but because both units are rented, he is actually collecting the $1,800. That's gross. That's going back into his account. That's how his retirement account is growing. Any of the expenses, if he had lawn care, if he had repairs, any of those expenses are going to be paid for out of the IRA. But right now, this is still an active investment. Gary is still collecting the rents and growing his IRA. But on this particular one, this is an example of something that Equity Trust does day in and day out. As I said, we do 3,500 transactions a day. This is a very common transaction that we would do. This one I love the most, and John is going to get into the real estate joint venture in great detail. Up to now, everything I've said is an example of someone who is investing with a family or investing with a prohibited partner, meaning that you're investing with someone up and down the lineal line, parent, grandparent, yourself, children, grandchildren, or your spouse. When you are investing with people who are disqualified from you, those profits, as I said, have to go back and forth in proportion to what you had invested. When you are not investing with a prohibited partner, you can change the rules. The minority investor can put the majority of the profit into their account. In this particular deal, even though it's drawn out on paper, John is going to go through this because this is one of his deals, one of his real estate joint ventures that he actually put together and executed on. John will go through several real estate joint ventures that he has done inside of his own accounts. But again, the beauty of this is the minority investor can put the majority of the profit into their account. This particular deal, it has 3 parties. None of these parties are disqualified from one another. In other words, they're not related to each other. John finds the investment, puts the deal together, brings in his money person, and then he also has a rehabber that works for him. So let me take you through the numbers first. This deal in Maple Heights, Ohio, $37,500 was what it was acquired for. $10,000 in rehab. Once it was rehabbed, they sold it for $97,500. After closing cost, there was 47,000, 90,000 minus 47.5. It was $42,500 in profit to divide. A real estate joint venture is nothing more than a business plan that you put together. It's a partnership when you come together. And John will actually take you through the paperwork on what he does for his real estate joint ventures. So he is participant number one. John put $2,000 into this deal. The business plan was put together to where at the time when the property was sold, the partners agreed that John was going to get 50% of the profit. The person who put up the majority of the money, $45,500, also got 50% of the profit. So participant number one and number two split the profit. The rehabber who did the work on the property, again, this is someone who did not put any money into it because had he put his IRA into it, then he couldn't work on the property. So this is just someone who is doing the work to the property. The business plan was you're going to get your rehab expenses paid, plus you're going to get a $5,000 profit when the deal sells. So the distribution was rehabber got his 10,000 plus his 5. Partners 1 and 2 split the profit. 18,750 went into each account. Keep in mind, John's $2,000 investment returned a profit of 18,750. Not a bad return. Some people will ask, well, why would someone put up the majority of the money and only get a portion of the profit? Keep in mind that this particular one, and John puts together deals very fairly. This particular one returned 41% ROI to the person who put up the money. So these are very interesting deals. It's how you can take a small account and rapidly grow it. We will go through several examples of these. These are things I see a lot happening in RIAs across the country, where you're meeting people who can you can do these deals with. And I see young people doing these, maybe with a more experienced investor to help you along the way. But we'll be going through several examples of real estate joint ventures. Again, this is a good way to grow those small accounts. And John will be using several of his own examples. So let's get into a little bit about the accounts, and then I'm going to talk about the workshop that's coming up. Three steps of doing it. You open an account, you fund an account, and then you tell us what you want to invest in. Again, we're not trying to open accounts tonight, so if you're really interested, you come to the workshop on the 21st. And I'll just tell you right now, it's a free workshop. So I'm not gonna, we're not trying to sell the workshop here. This is something that we are giving away to you. So why equity trust? I told you a little bit about our experience, our numbers. Wanted to also point out that Equity Trust started out as a traditional brokerage firm, offering stocks, bonds, and mutual funds. We still have ETC brokerage, and that's important because if our clients are in between an investment, rather than their money sitting in an idle cash account, with the Equity Trust platform, you can deploy it back into stocks, bonds, and mutual funds until you find that next deal. So John will be taking you through the brokerage services account, and we offer no load fee mutual funds. So John will be talking about the platform and what's possible with Equity Trust. Very important that I want to point out that we are an IRS approved custodian. Whether you choose to do business with Equity Trust or another company, make sure that you're doing business with a custodian. In this space, you have three different parties. You have a facilitator, administrator, and custodian. So the facilitator writes business for an administrator. Administrators write business for custodians. But it's only the custodian that is licensed and regulated by the Department of Labor and Internal Revenue Service. As I said, I'm getting closer to retirement. As I get close to retirement, where my money is invested is very important. I want to make sure that who my money is invested with has experience, has errors and omission insurance, has oversight. Equity Trust, our non-depository bank charter is out of South Dakota. So we have oversight by South Dakota Division of Banking. Because we have a brokerage service firm, we have government oversight by several more agencies, in all 7 different state and federal agencies. That's important. Knowing how your custodian is licensed and regulated is important. I can only say that I highly recommend that wherever you choose to do business, ask if they are a custodian. Ask how they are licensed and regulated, their level of experience, their financial strength. Very important to know these things so that you have a level of comfort, a level of security. But Equity Trust is an IRS regulated custodian. Experience is also important in this industry. Equity Trust is the largest self-directed IRA custodian. The experience level of our staff. Our average account liaison has 5 years of experience. The average account liaison has done 8,800 transactions, 2,800 of those being real estate specific. So we have more experience in this industry than any other self-directed IRA custodian out there. And our online platform, very robust. John will be going through the technology, going through the platform, demonstrating everything so that you can understand how to effectively, quickly and easily do your real estate transactions on our platform. And education, that is what Equity Trust is known for. Education is key. We don't sell our education. It is on our website. If you have questions, you can go to the Equity Trust website, trustetc.com. Go to the resource tab. You're going to see our live events there. You're going to see our past webinars, our past white papers. All of this education is on our website. What we're doing now is because, like everyone else, we have to be socially distanced. So we've gone from our live events to a virtual event. But the virtual events incorporate everything that our live events did. You're not going to be shortchanged because this is a virtual event. It will be recorded. Those people who attend it will actually get the recording. You have to attend it to get the recording. So this will be next Tuesday, July 21st, starting at 6 p.m. The agenda, I like it because it's not just Equity Trust teaching it. It's very important that you hear the case studies from the clients. And some of the case studies that you're going to hear are actually members of St. Louis REIA. So you're going to be hearing from some of your own members who are successful clients with Equity Trust. As John is teaching a concept, he'll be interviewing a client that is putting that concept to work and then coming back and whiteboarding it. So multiple layers of education so that you can understand what people are doing. And then how to partner your IRA. I went through a couple of examples. John will be going through 10 different case studies, 10 different scenarios of how you can partner accounts together. So you can understand, hey, I may not have enough money in my account now, but how can I partner with someone else? How can I partner with my own money and my IRA money? So I'm getting a revenue stream today and also saving for retirement. Those are the different kinds of case studies John's going to be going over. The power of the Roth IRA and the Roth conversion. John is the most passionate person I know out there when it comes to tax-free investing. Investing in real estate in the absence of taxation, growing your wealth in a tax-free environment. He is going to be going over multiple examples of how you can move your money from your taxable to non-taxable, and then what you can do with that account once it's in a tax-free environment. And again, whatever you are doing outside of your IRA, you can be investing in inside of your IRA. Whether it be a fix and flip, buy and hold, lease option, seller finance, all that can be done inside of a self-directed IRA. John will be going through several different case studies, several different client interviews with people that are doing these various types of investments. So again, not just hearing it from Equity Trust, I think it's even more important hearing it from our clients. So we'll be doing some client interviews during the workshop on the 21st, so you can actually hear from the client themselves. Then the technology platform. John will be using some of his own investments, taking you through the technology, again, so you understand how to process your investment, why it's important to work with your custodian from the very beginning to make sure you do everything correctly, and how to speed that transaction along. As we do more and more digitally, more and more automated, it speeds the transaction along. So John's going to demonstrate ways of speeding your transaction as well. And a lot on small dollar investing. I talked about the joint venture, the real estate joint venture, but also doing wrap loans, lending your money out. Just various ways of taking a small account and rapidly growing it. One of the examples John is going to use is a lady who never put more than $500 into her account. In her first 5 years, I had the account to $34,000. First 3 years, it was at $64,000, having never done more than a $500 investment into the account. So he'll be going through some of those transactions as well, so you can see just what's possible. And then finally, the private lending. We see private lending as being very, very popular right now, where I may have an account but don't have a deal, but I can lend my money out to someone else in the REIA that does. And John will take you through scenarios of, don't just take a simple interest rate. What about taking a percentage of the profit? Different ways of structuring that, and he'll whiteboard these so you can see different ways of better structuring it to get larger returns. So there are some free downloads. When you register, and after the meeting, John will be sending out the registration link so you can register for the workshop. But when you register, the first report that you're going to get is the 10 ways of partnering your IRA. So everybody's going to get this report that registers. It's a free report. It'll take you through 10 different examples. John will take you through various case studies on the 21st and interviews with our clients talking about the various ways that they are investing. Those people who attend, the people who take action get rewarded. So when you attend the workshop, you will also get another report. It's 100 investment options that you can do with your self-directed IRA. 100 different examples of what our clients are doing to grow and preserve their wealth. And the final thing that you're going to get for those people who attend, you'll get a video back on conducting your first your first self-directed IRA. Again, this is an interview with a client, taking step by step. What did they do? How do they do it? How do they process the transaction? And you'll get that video back free when you attend the workshop on the 21st. And I won't even build up. This is a free workshop, as I said. It is free to attend. We're not trying to do an upsell here. There is no boot camp to buy, no educational course to buy. This is it. John will be doing a 3.5 to 4 hour workshop on investing in real estate-backed notes out of a self-directed IRA. The call to action is, if you want to open an account, schedule a call. Even if you have an account with Equity Trust already, come hear the new case studies, register and attend. If you are with another custodian, register and attend. You're going to get some ideas of what you can do with your account that you might not even know. So whether you're with Equity Trust or not, I encourage you to register for the workshop. John, again, will send out the link to register after the event. You can also send me an email, and I'll send you back the St. Louis REIA link. My email is at k.kinzer, K-I-N-Z-E-R, @trust, and then the letters ETC for equitytrustcompany.com. With that, hey, I said it'd be 1 hour and 15, and I think I only talked for 1 hour and 10, so I'm giving you about 5 minutes back. I think I answered most of the questions. I saw a question come in. I want to make sure I answered it correctly. Let me get back to my email. There was one question that was asked. Oops, here we go. Give me just a second, John. Let me find my, it was on someone transferring, they had a Roth IRA at a brokerage firm. If they transferred it to Equity Trust, does the seasoning start over? The answer to that is no, it does not. Wherever your account is, it's already started its seasoning from the moment you open a Roth IRA, whether it be with Equity Trust or someone else. Whenever you opened it, that's when your seasoning started. And then there was a follow-up question. Say someone has an existing IRA. They move to Equity Trust. Okay, that again, it was the same type of question. Actually, all three of these questions related to having an existing Roth and when does the seasoning start. So just to go back on the seasoning, a Roth IRA has to season for 5 years. It starts its seasoning from the moment you open it. It's actually, if you open it in December of last year, its seasoning started January 1. It always goes back to January 1 of that day, that year. It has to be seasoned for 5 years before you can take the growth out. So it doesn't matter where the account is. If you have an account that you opened 5 years ago, you bring it over to Equity Trust. You just start doing your investing with that IRA. Once you hit 59.5 and you've had an account seasoned for 5 years, that's when you can start taking your qualified distributions out of your Roth IRA. So we had 3 questions coming about that. I think I answered all 3 of those. John, did you have any other questions for me?
There's a couple I think that somebody just typed in. Can you, let's see here. Can you make a trust the beneficiary, I guess, of your IRA is what they're asking here.
Absolutely. And John will be going through investing with a real estate trust. We see a lot of that at Equity Trust. Again, just another level of asset protection is usually why I see it. Also could be anonymity purposes that people want to invest inside of a trust. But absolutely, John will be talking about and giving examples of a real estate, an IRA-owned trust.
Okay, excellent. Oh, and then we have one here. Can I transfer funds from a 401k to a self-directed Roth IRA?
So that one has a couple of caveats. It depends on your age generally. So if you are still employed and you're still with your employer, you have to find out if they will allow you to do an in-service distribution. You have to talk to your plan administrator. I'll tell you, having been in this industry for 9 years, if you're under the age of 59.5, the answer is usually no. There are some employers I know out there, Boeing, some of the federal agencies will allow you to do it. But if you are over the age of 59.5, you've hit that magical point when you can start taking distributions. If you're still employed and 59.5, then you can transfer that account, that existing 401k to Equity Trust. You roll it over. But we have to find out from your plan administrator, if you're under the age of 59.5, does your plan allow you to do an in-service distribution? If it does, then yes, you can port that account over and use that existing 401k to do a self-directed IRA. We get that question quite a bit. We know the questions to ask. We can make that call with you to your plan administrator. It's usually someone in your HR department, and we can either give you the questions to ask or be on the line with you and help you with that.
Okay, excellent. And then one more here. This is a couple of different questions, but this one may be something to call in on a personal level. But it says, do you have Roth CDs? Are your rates competitive, and are there any fees?
I'd have to let John answer that. Not CDs. They're going to be wanting to invest in maybe a mutual fund. John will be talking about how you can invest, especially if you're in between an investment. That's when I see people moving their money back into the traditional stocks, bonds, and mutual funds. If you only want to invest in traditionals, if that's your sweet spot, if you don't have any desire to do an alternative investment, whether it be in real estate or lending your money out to someone else. If you're only going to keep your money in the stock market, you would be better off keeping it right where you are and not rolling it over to equity trust. And we'll be quite frank about that. People who have an account with equity trust, they want to do something other than just stocks, bonds, and mutual funds. Usually you're invested in real estate-backed notes. That's what you have experience in, what you have expertise in. But yes, we have a brokerage firm. Yes, you can invest in mutual funds. We have no load fees with our mutual funds. John will go over that at the workshop on the 21st. You'll get more detailed information at the workshop. But that was a long answer to a short question. But if you just want CDs, keep it where you are now.
Yeah, great answers. Any more questions out there? I think you did such a great job, Ken. I tell you what, this was more than just a sneak preview. It's a lot of good education you just gave us right here.
Well, I tell you what, the real education comes with John.
Yes.
I don't mind at all being called second string to John. John is the best in the industry. He's half my age and twice as smart. And unfortunately, every single word in that statement was true. John reads tax code for light reading and enjoyment, but he is someone who can take a very difficult subject and boil it down to where everyone can understand it. Very passionate about educating people, and very, very passionate about educating people on how to invest free of taxes. He is all about helping people get to that 0% effective tax bracket before they retire. I learned so much for John, and I'm not joking when I say that guy is about half my age and he's at least twice as smart.
Well, you're very smart yourself, Ken. We really appreciate. Actually, your company does such a great job. You guys all do. It's simplifying what can be such a complicated subject and making it so I can understand anyway. And I know some of the other members really appreciate it. We do have a lot of members that actually use your service because it's just so invaluable for us investors, and we really appreciate it.
You've got some very experienced people, and for those of you that are on the line that aren't already members of St. Louis REIA, again, when I say you're going to be rubbing shoulders with some very experienced people, Ruth, who's an officer, she's got decades of experience. I use some examples today with members of the St. Louis REIA, and you'll be hearing from them at the workshop on the 21st. That's I think the best reason to join REIA is that networking opportunity that's afforded to you when we get back to our regular meetings. Join and be an active participant. If you're really interested in real estate, this is where you get that local knowledge. I encourage you, if you're not a member, join. So that's all I had. Make sure you register for the workshop on the 21st. John will be sending out that link. If you had a question for me and didn't want to ask it, send me an email, or if you don't get the link, send me an email. I'll make sure I get the St. Louis REIA link out to you.
Thank you so much, Ken. And yeah, be sure to register for next week if you haven't already. It starts at 6 p.m. on the 21st, which is Tuesday. And this is a great workshop. I know when you guys were here before, I still have a whole book full of notes that I refer to back and forth. But I just so much appreciate you. We look forward to next week.
Absolutely. Thank you so much, everyone. Stay safe.
Thank you again, Kent. Appreciate it. Thanks everyone for joining. Bye now.